Attention Florida homeowners and prospective buyers. There's a silent crisis brewing in the Sunshine State's housing market. Massive, unsold new constructions are flooding specific corridors, creating ghost developments that could force a market correction in your area. This isn't just about empty houses. It's about the potential ripple effect on your property's value. Are you prepared for what's coming? Behind the palm trees and pastel stucco facades, Florida is facing a paradox that threatens to unravel years of real estate prosperity. Thousands of brand-new homes sit vacant, even as the state continues to attract new residents. According to Redfin analysis, Florida's active inventory surged 16.8% year-over-year as of March 2025. Signaling a fundamental shift in market dynamics. In Cape Coral alone, inventory has exploded to over 14,500 homes, the highest level in more than a decade. This isn't a temporary blip. It's a structural problem that exposes the dangerous gamble developers made during the pandemic boom. They built for a future that never arrived, and now the consequences are rippling through neighborhoods, municipal budgets, and property values across the Sunshine State. In this deep dive, we're exposing how Florida's burgeoning inventory of unsold new construction poses a significant threat to the broader housing market and what it means for your financial future. Subscribe to Housing Intel for data-driven real estate intelligence you won't find anywhere else. Florida's silent crisis. Empty homes everywhere. Drive through the corridors of Southwest Florida, Central Florida, or the Panhandle, and you'll see something unsettling. Street after street of pristine new homes, landscaping perfectly manicured, but no cars in driveways, no children playing, no signs of life. These are Florida's ghost developments, and they're multiplying at an alarming rate. Nationally, unsold completed new home inventory hit 121,000 units in July 2025, the highest level since 2009. Florida accounts for a disproportionate share of that glut. In Cape Coral and Fort Myers, the Federal Reserve Bank of St. Louis reported over 10,670 active listings in September 2025. Down slightly from over 13,000 in May, but still dramatically higher than pre-pandemic levels. Compare that to just 5,586 listings in 2023, and the scale of the problem becomes clear. This isn't just about construction outpacing demand. It's about developers who assumed the pandemic-era migration surge would continue indefinitely. They broke ground on massive projects, betting on endless population growth and ever-rising prices. But migration has slowed, insurance costs have exploded, and mortgage rates remain stubbornly above 7%. The result? Thousands of homes that nobody wants to buy at current prices. In Punta Gorda, inventory levels have doubled year over year. In Jacksonville and Orlando, new subdivisions sit partially occupied, their model homes the only signs of activity. The paradox is brutal. Florida is still growing, but not fast enough to absorb the tsunami of new construction flooding the market. And that mismatch is creating the conditions for localized price corrections that could spread like wildfire across vulnerable corridors. The boom and the bust. How we got here. To understand how Florida arrived at this crisis, you have to go back to 2020. When the pandemic hit, remote work suddenly became the norm. High-tax northern states lost their appeal. Florida, with no state income tax, year-round sunshine, and relatively affordable housing, became the promised land. Between 2020 and 2022, Florida gained over 660,000 new residents. Home prices skyrocketed. In Cape Coral, median prices jumped from $230,000 in 2019 to over $400,000 by 2022. Developers saw dollar signs. They bought land aggressively, pulling permits at a breakneck pace, and launched projects across Southwest Florida, Central Florida, and the Panhandle. The assumption was simple: demand would stay red-hot forever. They were wrong. By late 2023, cracks began to appear. Mortgage rates, which had been near 3% during the boom, climbed past 7%. That meant a buyer who could afford a $400,000 home at 3% could now only afford a $300,000 home at 7%. Overnight, the buyer pool shrank dramatically. Then came the insurance crisis. Homeowners' insurance premiums in Florida averaged $3,748 annually by September 2025, up 34% from May 2022. In high-risk coastal areas like Fort Lauderdale and West Palm Beach, premiums exceed $10,000 per year. For many buyers, that's an additional $800 to $1,000 per month on top of already stretched mortgage payments. The math simply stopped working. Migration slowed. According to U.S. Census data, Florida's net migration in 2024 was less than half of what it was in 2021. Developers who had bet on sustained demand suddenly found themselves sitting on thousands of unsold units. In Cape Coral, inventory surged from 10,314 in 2024 to 14,580 in 2025. That's a 41% increase in just 1 year. In Punta Gorda, listings doubled. In Jacksonville, new subdivisions that were supposed to sell out in months are still sitting with dozens of vacant homes. The boom had turned into a bust, and the fallout is just beginning. Southwest Florida is ground zero for this crisis. Cape Coral, Fort Myers, Punta Gorda, and surrounding areas became overbuilding hotspots during the boom. Between 2020 and 2023, developers added tens of thousands of new homes, betting that the migration wave would continue. It didn't. By mid-2025, inventory levels in Cape Coral had reached the highest point in over a decade. Fort Myers wasn't far behind. According to Reventure app data, active listings in Cape Coral climbed from 5,586 in 2023 to 14,580 by 2025. That's a 160% increase in just 2 years. Days on market ballooned. Homes that once sold in a week now sit for 60, 90, even 120 days. Price cuts have become routine, with sellers slashing asking prices by $20,000, $30,000, even $50,000 just to generate interest. Central Florida is experiencing similar pain. Orlando and Tampa, which saw massive construction booms fueled by out-of-state investors and corporate relocations, are now grappling with oversupply. New subdivisions in suburbs like Davenport and Claremont sit partially vacant. Builders who rushed to capitalize on demand are now offering incentives that were unthinkable 2 years ago. $60,000 price reductions, paid closing costs, mortgage rate buydowns to 5%, even free upgrades worth $30,000. These desperate measures are dragging down comparable sales across entire zip codes, creating a downward spiral in property values. Even the Panhandle, long considered a more stable market, is showing stress. Panama City Beach and Pensacola, which attracted heavy investor interest during the boom, are now seeing inventory climb and sales slow. The pattern is clear. Overbuilding in specific corridors has created localized gluts that threaten to destabilize broader regional markets. The economic ripple effect, more than just empty houses. The consequences of Florida's ghost developments extend far beyond unsold homes. For developers, the financial strain is crushing. Smaller builders, who lack the capital reserves of national giants, are walking away from projects mid-construction. Some are facing foreclosure. Lenders who finance these projects are growing nervous. If developers default, banks get stuck with unsold inventory in a declining market. That's a recipe for significant financial losses. According to Bloomberg analysis, unsold completed inventory for major home builders hit a 16-year high in 2025. Companies like Lennar have even launched investor marketplaces to offload unsold units to institutional landlords, a sign of desperation disguised as innovation. For local governments, the problem is equally severe. Property taxes fund schools, roads, police, and fire services. When home values stagnate or fall, tax revenues shrink. Florida municipalities that banked on ever-rising assessments to fund budgets are now facing shortfalls. In Cape Coral, where property values surged during the boom, a correction could hammer the city's ability to provide basic services. The same dynamic is playing out across Southwest Florida and other overbuilt corridors. And it's not just new construction. The glut of unsold new homes is dragging down values for existing homeowners. When builders slash prices by $50,000 to move inventory, it sets new comparable sales. Appraisers use those comps to value nearby homes. Suddenly, a homeowner who bought at the peak finds their property worth less than they paid. Equity evaporates. Refinancing becomes impossible. For retirees who move to Florida expecting their home to appreciate, it's a financial nightmare. Then there's the risk of a foreclosure wave. If developers can't sell inventory and can't service their debt, lenders will foreclose. Those homes will hit the market as distressed sales, further depressing prices. In Southwest Florida, where overbuilding was most aggressive, this scenario is entirely plausible. The ripple effects don't stop there. Construction is a major employer in Florida. When builders stop breaking ground on new projects, construction workers lose jobs. Suppliers see demand dry up. Real estate agents earn fewer commissions. The economic impact cascades through the entire state economy. What started as a housing market problem becomes an employment problem, a municipal budget problem, and a broader economic stability problem. Florida's ghost developments aren't just empty houses, they're economic time bombs. Who's buying or not buying now? The buyer pool that fueled Florida's boom has vanished. First-time buyers, already stretched thin by rising home prices, have been priced out entirely by 7% mortgage rates and soaring insurance costs. A median-priced home in Florida now requires a monthly payment of over $3,000, including mortgage, taxes, and insurance. For a buyer earning Florida's median household income of around $65,000, that's simply unaffordable. The math doesn't work, so they're sitting on the sidelines, waiting for prices to fall or rates to drop. Neither seems imminent. Out-of-state buyers, who drove much of the demand in 2020 and 2021, have also pulled back. The allure of Florida's no-income tax status hasn't changed, but the cost of entry has skyrocketed. When you factor in homeowners' insurance premiums that can exceed $10,000 annually in coastal areas, the value proposition collapses. Many would-be buyers are reconsidering whether Florida is worth the financial strain. Investors, both individual and institutional, are retreating. During the boom, investors accounted for over 30% of Florida home purchases in some markets. They bought properties sight unseen, often paying cash, betting on continued appreciation and strong rental demand. By 2025, that strategy has soured. Home prices have flatlined or fallen in many markets. Rental yields have compressed as new supply floods the market. Insurance and property tax costs eat into already thin margins. Investors who bought at the peak are now facing negative cash flow. Some are dumping properties, adding to inventory and accelerating price declines. Real estate agents on the ground describe a market gripped by hesitation. Buyers who do show interest are hyper-price sensitive, demanding concessions and refusing to pay list prices. Multiple offer scenarios, once routine, have disappeared. Homes sit for months, with sellers forced to accept lowball offers or pull listings altogether. According to interviews with Southwest Florida agents, buyer sentiment has shifted from fear of missing out to fear of catching a falling knife. Nobody wants to buy now if prices are going to be 10 or 20% lower in 6 months. That wait-and-see mentality creates a vicious cycle. Fewer buyers mean more inventory, which means more price cuts, which reinforces the belief that waiting is the smart move. Institutional investors, once seen as a stabilizing force, are now part of the problem. Major players like Lennar are actively courting landlords to take unsold inventory off their hands. But even institutional buyers are cautious. They're negotiating deep discounts and cherry-picking only the best deals. That leaves the rest of the inventory languishing. The bottom line? Demand has collapsed just as supply has exploded. It's the worst possible combination for sellers, developers, and anyone holding Florida real estate in vulnerable corridors. What happens next? Navigating the uncharted waters. So where does Florida's housing market go from here? The most likely scenario is localized price corrections. Markets like Cape Coral, Punta Gorda, and parts of Central Florida will see continued price declines as oversupply works its way through the system. How steep those declines get depends on how aggressively developers cut prices and how long it takes for demand to return. In some submarkets, a 10 to 20% correction is entirely plausible. For sellers and homeowners, that means watching equity vanish. For buyers, it means opportunity, but only if they can stomach the uncertainty. Developer bankruptcies are another real possibility. Smaller builders without deep pockets or access to capital are already walking away from projects. If market conditions worsen, more will follow. That could trigger a wave of distressed sales, further depressing prices and creating a downward spiral. The alternative scenario is a slow absorption of inventory. If mortgage rates fall and migration picks up, demand could gradually absorb the glut without triggering a full-blown crash. But that requires economic conditions to improve, which is far from guaranteed. For current Florida homeowners, especially those in overbuilt corridors, the advice is simple. Don't panic, but don't ignore the warning signs. If you're planning to sell in the near term, understand that it's a buyer's market now. Price aggressively, offer incentives, and be prepared for a longer timeline. If you're planning to stay long-term, the short-term fluctuations matter less. Focus on the fundamentals: your local job market, infrastructure investment, and long-term migration trends. For prospective buyers, the risk-reward calculation has shifted. If you're buying in a vulnerable market, you could catch a falling knife. Wait for clear signs of stabilization. Inventory declining. Days on market shrinking. Price cuts becoming less common. Don't let seller desperation lure you into a bad deal. But if you're buying in a stable market with strong fundamentals, the current softness could present a rare opportunity. Investors should be even more cautious. The easy money has been made. Cash flow is tight. Appreciation is uncertain. Insurance and tax costs are rising. Unless you're getting a deal that makes sense on day one, with rental income covering all expenses and providing a cushion, walk away. The data is clear. Florida's housing market is at a turning point. The pandemic boom created unsustainable conditions, and the market is now correcting. How severe that correction becomes depends on factors largely outside individual control. Federal Reserve policy, insurance market dynamics, migration trends, and developer behavior. What you can control is your own decision-making. Arm yourself with data. Understand local market conditions. Don't rely on outdated assumptions about Florida's invincibility. The ghost developments are real. The inventory glut is real. And the potential for localized price corrections is very real. Knowledge is your greatest asset in a volatile market. The message is undeniable. Florida's unsold new construction isn't just a developer problem or a lender problem. It's a systemic threat to the broader housing market, with the potential to drag down property values, destabilize municipal budgets, and force painful financial reckonings for homeowners and investors. From Cape Coral to Orlando, from coastal retreats to inland suburbs, the warning signs are flashing red. Ghost developments are multiplying, inventory is surging, buyers have vanished, and prices are starting to crack. This isn't a prediction anymore. It's the reality unfolding right now across specific Florida corridors. But here's the thing. Armed with this information, you can make strategic decisions. You can avoid the traps, wait out the chaos, and position yourself for the recovery when it comes. You can protect your equity, time your entry, and navigate the uncertainty with clear eyes. Don't let hype or fear cloud your judgment. Stick to the data. Understand the dynamics, and act accordingly. If this analysis opened your eyes, smash that like button right now. Subscribe to Housing Intel for weekly data-driven real estate intelligence that cuts through the noise and delivers the insights you need to make informed decisions. Ring that bell so you never miss an update. And drop a comment below. Which Florida market shocked you the most? Are you buying, selling, or waiting this out? We read every single comment. We'll see you in the next breakdown. Because sometimes, knowing where not to buy is the best investment decision of all.